Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. Markets across the Asia-Pacific are reacting to weaker than expected U.S. jobs data. The delayed report showed the unemployment rate rose last month to 4.6%. That's the highest level in more than 4 years. Now, the story on payrolls was mixed. The American economy added 64,000 jobs in November, although in the month of October, the economy lost 105,000. Here is the acting head of the White House Council of Economic Advisors, Pierre Yared.
If you look over the totality of those 2 months, you have the U.S. economy creating 121,000 private sector jobs and shedding 162,000 government jobs. Now, a lot of those government jobs went away because of the fork in the road efforts, the DOGE efforts that meant that many people who were retired from the federal government basically went off of payroll in the month of October. And so that explains what happened there.
That is Pierre Yared. He is the acting head of the White House Council of Economic Advisors. Now, analysts are saying the more meaningful jobs report will be December data for release in early January. For a closer look, I'm joined by Christopher Zook. He is the chairman, also the CIO at CAZ Investments. Christopher's on the line from Houston, Texas. Thank you for being here. Give me your sense of what you learned from this jobs data.
I think the economy's softer than the data would indicate. The numbers themselves have a lot of noise in them because of the shutdown and also because of the fact that it is cloudy. And in your previous segment, you talked about how the gentleman from the White House Economic Council talked about how you had a lot of private sector jobs added, then you had a lot of government jobs that were removed. And that certainly is an interesting dichotomy of efficiency. But what we're seeing in the last couple of months is a lot more of the private sector jobs also being eliminated, primarily in the middle sector and what we refer to as the hollowing out of the American workforce, where it's not really the top tier jobs and it's not really the bottom tier jobs that are being eliminated, but the stuff in the middle. We're seeing a lot of that as a result of AI and other reasons as well.
So we know the labor market is one half of the Fed's dual mandate. The other, of course, is inflation. And today, the head of the Atlanta Fed, Raphael Bostic, was saying that the Fed should remain focused on addressing inflation, with elevated price pressures expected to persist through most of next year. Does he have a point here?
I do think he has a point, because I think we have sticky inflation that's being caused by a lot of different factors related to the transition of power at the White House and certainly in Congress, a lot of the onshoring efforts. But just the reality is that some things are not being produced at the same level of price that they used to be. And then some other things that are not related to really anything somebody can control. When you look at cattle prices and other things, it's just, there's so much of a pressure from a spending consumer, whether they should or not, they're still spending. And as a result of that, you're seeing these pressures. You do have some productivity gains because of AI and other reasons, but we are seeing consistent and constant inflation that doesn't appear to be going away anytime soon. The only thing that we could really forecast that would cause investors or the economy, I should say, to really, really stop being an inflationary spiral is a very serious economic downturn, which we hope doesn't happen. But that obviously is something that the Fed is not anticipating, which means they need to stay diligent against inflation.
So right now, if I'm not mistaken, the swaps market indicates 2 rate cuts for 2026. Is that your view?
So, I think that's right. I mean, I'm not going to argue with them. The Fed, of course, has one, that they're showing. Now, whether or not one happens right in the beginning of 27 or in 26, that's going to be data driven. What I can tell you is this: the Fed is in a box and has been in a box for a long time. They overcorrected on the downside. They overcorrected on the upside. They're trying to find that happy median. I'm not sure that they're there, but they believe they're there. And I don't think they have a lot of room to cut more aggressively because of those inflationary pressures that we just talked about. I think the Fed is really kind of stuck. And that's one of the reasons why for several years now we've talked about stagflation. And we think that's where we're headed. We've already been. And we think we're headed there as well in 26, is a relatively stagnant economy, but with sticky inflation.
So one of the things that is influencing the level of inflation, accelerated level of inflation, is rising electricity bills. And today, 3 Democratic senators basically indicated they will investigate whether and how the operations of certain tech companies are driving up these prices for electricity. Is this something that's going to be with us now as we continue to move more into this age of artificial intelligence?
Yes, and I have to laugh because of the fact that I'm literally chuckling out loud because it is so much like a politician to say, okay, we haven't done all the things that we should do to expand electricity capacity. We have not invested in infrastructure and new lines and new technologies to expand the ability to get more energy. So now that somebody's using a lot of it, let's go tax them somehow. So that's a very jaded view, but it sure sounds like what you just stated, those senators did talk about. There is absolutely no question that the AI demand on the grid is going to continue to be higher, and it's going to accelerate at an accelerating rate. But it's not just AI. It's just the fact that you have so many people around the world that are obviously moving from lower class into middle class into upper class, and they just all demand more electricity when they get a new iPhone, or for the first time they actually have heat or power in their home, they're going to spend more. And so it's one of the reasons why we are absolutely as bullish on energy in the long run as we have been in my nearly 35-year career. And, being in Houston, Texas, we're very, very close to the energy world. In the short run, there'll be a lot of volatility, but in the long run, the supply-demand imbalance is only going to get worse, and we have to be investing in all forms of energy, all kinds, in order to be able to meet the demand that we're seeing coming, because it's just going to accelerate.
So close to the energy world when it comes to crude oil and natural gas, but doesn't Texas operate its own grid, and isn't that a potential problem?
Oh, it has been. And yes, a lot of people don't know this, but in the United States, there are 3 grids. There's basically East, West, and then there's Texas. We're pretty proud of that, as a matter of fact. But at the same time, our grid can be vulnerable to things. In 2021, as an example, we had the horrible freeze that literally took power down for millions and millions of people because of the fact that the power stations themselves froze. And so, like anything else, if you don't have proper backup and contingency power in place, bad planning is going to end up to bad results. So one of the things that Texas has worked really hard on for the last couple of years is replacing that excess capacity. And, we use a tremendous amount of solar in the state, a tremendous amount of wind in the state, but you can't always count on the sun shining and the wind blowing. So you have to have plenty of baseline power. That is something that we are continuing to invest in, but certainly need to do a better job, just like every other part of the United States and around the world. But it's like anything else. People don't spend money on something until they really realize, oh, I need this, and it's a big problem if we don't have it. Fortunately, Texas, we're trying to get caught back up after not probably spending enough. But other parts of the country, we've seen in California and other places where they are really behind, and it is going to be, I have a favorite saying, which is people will stay the same until the pain of making the change is less than the pain of making the change itself. So people will stay the same until they don't have a choice. And that's what we think is going to be the case in many states. And that's going to create a significant increase in spending. But we have to find new energy sources, whether it be nuclear or obviously traditional uses of energy, fossil fuels. But basically all of the above is going to be required. We're most excited about nuclear and small modular reactors in particular, but we know there's going to be enormous demand for traditional fossil fuels as we go, for the next several decades.
How are you feeling about the overall trade as it relates to artificial intelligence and some of these big data center owners that are having to take on a little bit more debt to maintain their build out?
I'm concerned about the amount of spend that is out there, particularly when it's being serviced with debt. I do believe that you're going to have significant demand for these data centers, but if their pricing is high enough, people will find alternatives. We've seen a couple of headlines recently about potentially putting significant amount of data center capability actually in space, where if you have a satellite there that is a data center, the sun is always shining. And with now the technology of Starlink and others, you have the ability to, get that information down to wherever it is needed here on Earth. I don't know if that is plausible yet. It sounds feasible, but I know there's going to be billions of dollars investigating the possibility of it. So as we look to the data center world, there could be several of these very large, expensive data centers that don't have near as much demand for them as they originally thought, and that could bite some people and make it painful for them. I'll put it that way. We are looking very hard at what can be done in space and other places, but it's early days. But I am concerned about people spending too much just based on what might possibly happen over the next 5 to 7 years.
Give me your best case scenario for 2026. What does the outlook appear to be for the new year?
I think the best case scenario is that we could see a pretty significant expansion of earnings that could lead to better prices. However, prices are really, really expensive. The S&P 500 is one of the most expensive environments we've seen ever. You got to go back to 1999. A lot of people don't even realize that 25% of the S&P 500 is now trading at more than 10 times sales, not 10 times earnings, 10 times revenue. That's the only time we've ever seen. It was 2021 in the middle of the SPAC bubble and 1999 when we obviously had the tech bubble. So we are very concerned about the overall valuation. So we could make you a much stronger bear case. But your question was the bull case. The bull case is that earnings continue to expand at a decent clip, call it 10% or so next year, and that valuations stay strong simply because of the fact that the Federal Reserve is lowering rates and we do not have too much of a spike in long rates. And so therefore valuations stay okay, and that we see earnings, decent growth as we look at the new year. That's our best case. I can make you a lot of bear cases that are much worse than that. So it's very important for people to be in a position to feel comfortable with the valuations in their portfolio. We have an old adage, stocks always go down faster than they go up. So sell when you can, not when you have to.
So, Christopher, you seem inclined to make the bear case. I can give you maybe a minute or so to do so.
The bear case is that you see reasonable earnings growth or flattening earnings growth, and then you see a significant pullback in valuations. We could build you a case that's down 20% in the S&P 500 simply because of the fact that those wildly expensive companies that make 25%, they just pull back 20% in valuation or 30% in valuation with 10% growth. You can get a down 20 market. The over-under, I think you have a flattish market next year to down 10. With a lot of volatility in between.
All right, we'll leave it there. Christopher, thank you so very much. Christopher Zook is chairman, also the CIO at CAZ Investments, joining from Houston, Texas, here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. China will have another major chip debut on Wednesday. This is MetaX Integrated Circuits Shanghai company. It's set to begin trading today in its home city. MetaX makes graphic processing units for artificial intelligence developers. Now, this company raised $585.8 million in an IPO that was nearly, are you ready for this? 3,000 times oversubscribed in the retail portion. We took a closer look at the AI trade with Daniel Lam. He is head of equity strategy at Standard Chartered Wealth Solutions. Daniel spoke earlier with Bloomberg TV host Avril Hong.
So, Daniel, there are a couple of things to watch in the market. What is top of mind for you? Because it looks like a bit of a struggle into the end of the year. Is this just repositioning? Traders have just clocked off for 2025, or is this more worrying signs that we need to pay attention to?
Right now, I believe the market number one concern is about the AI stocks. Are they going to get back, the returns that they have projected after such big investments? How are they going to finance for this kind of investments? Because many of these companies are tapping for the debt market right now instead of using the free cash flow. So it's not as clear a picture as, say, this year or a few years before. So that's what we see as the number one key risk in the markets right now. And that's the reason why you're seeing the correction.
So you're expecting this to continue for the next couple of months, or is there something that could turn this dismal sentiment towards AI-related stocks around in terms of perhaps earnings growth as a driver?
Well, earnings growth has been strong. It is more about the guidance of the companies. So towards the end of the last, the Q3 earnings season, basically, there were a couple of companies that have demonstrated some weakness. Right? At least markets feel that the guidance was not as good as what they're expecting. And, it's fair to ask because at such valuations, people would be asking a lot, for them to perform, both in terms of results and also in forward guidance. So that's fair ask. But at the same time, you have to understand that, over the last few years, we've had a number of false starts for the value stocks. And these kind of value rotation never lasted for a prolonged period of time. So actually we're not expecting this time to be any different. We believe that investors should still be adding to the AI stocks on the dips because if you look at how much they're dominating the U.S. Economic growth, this year basically 2/3 of the U.S. economic growth comes from AI or AI-related investments. That's a lot. And the capex is projected to be growing at 40% again next year. So that's hefty numbers, and they're still going to carry the flag for the U.S. economic growth.
Given your point, though, about how concerned investors are about this AI payoff, and that seems to be lingering, might it not make sense to perhaps pick up value tactically?
Tactically, but how much tactically? If you're for the medium to the longer term, the growth area is still on the technology stocks. So, our stance would, rather than trying to catch that value bounce, it is probably wiser to be looking for levels that you like and be adding on dips for the AI and technology stocks in general.
Does that mean that next year, in terms of the markets that can outperform, is it still going to be the likes of Japan, South Korea, Taiwan in your mind? Because we have been seeing this narrative emerging about the likes of India, for example, that they might benefit because they don't have an outright way into the AI trade per se.
Well, India is a little bit different because it's a very domestically oriented market. And actually, their latest GDP growth number was very encouraging. It's at 8.2% versus the projected 7.4%. So that means that the government tax reform has been working into the real economy. And also the monetary policy has been easing as well. So that's good to see. And earnings seems to have bottomed out. So actually, it's a market that we like. We're overweight India next year.
On top of that, what are you seeing in terms of perhaps the rupee weakness feeding into the appeal of Indian stocks as well?
Well, basically, that helps the Indian companies to be, for the exporting companies, it actually helps them. So that's a good sign to see because they do export services as well. And in general, the market this year has underperformed. So the valuation is, people are always saying that India is expensive, but it's gotten to a more reasonable valuation now. So that's another plus that we see in the markets.
We've also been seeing going the other direction from the rupee is the Chinese yuan. I wonder, how do you see that figuring into the equation when you look at Chinese stocks?
Basically, yes, the yuan is looking relatively strong versus, the recent past. But at the same time, I would say that China's economic data has not been stellar, right? The last set of data. So the government would probably be having a bias towards an easier monetary policy rather than a stronger one. Okay, so the yuan is probably going to be staying around the current level. unlikely to be appreciating significantly from here.
And how might that feed into what you're seeing in Chinese stocks? I mean, where do you see the momentum coming? Are there specific sectors that you are especially optimistic on?
Well, we have just got a truce between China and the US. I mean, going back to October, you're seeing that basically Trump was saying that he wants to slap a high tariff on China, and never came to fruition. And it is basically a truce out of convenience, as I term it, because of the fact that they have leverage on each other. So China has the rare earth card and US has the lead in technology. So both sides believe that it is best to have a truce out of convenience so that they can work to lessen the leverage that the other side has on them. So for China, it is about catching up further on the technology side of things. And that's where we believe the opportunities lie in Chinese stocks.
How else are you positioning as well? Because we are all hearing about that consumption push that authorities are trying to engineer. How might that also affect positioning?
Well, basically, there's the anti-involution campaign. But I believe that is still going to take some time. If you look at the earnings for the consumer stocks that are under heavy price competition, they're not there yet at this moment in time. So for the first half of the year, the positioning is about going for the stocks where there's AI technology and self-sufficiency theme. And after that, perhaps revisiting the stocks that can benefit from the anti-involution, because the end game is going to be that you'll be left with a few big players, right, such that they have finally got the pricing power, and the smaller players will be pushed aside.
When it comes to policy, Daniel, I got to ask you about the policy mix out of the US and how that is going to affect the overall trajectory for Asia stocks in the first half of next year.
Well, the Fed is saying that next year they'll be cutting once more. But with a Fed new chairperson, perhaps that will be tilting towards the dovish side. So our stance is that next year there's probably going to be 2 to 3 rate cuts from the US, rather than the one that the Fed has mentioned in the last FOMC. So if that's the case, that the dollar is going to weaken more, and that is probably going to be helping the EMs, okay, because they usually do well when dollar weakens. So that's the reason why we are overweight Asian stocks. And also in terms of the EM local currency bonds, we do like them as well.
That's Daniel Lam, head of equity strategy at Standard Chartered Wealth Solutions, speaking with Bloomberg TV host Avril here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.